4 months, millions of Americans have been struggling with rising prices. The latest Bureau of Labor Statistics report shows that inflation cooled more than anyone expected. In June, consumer prices actually fell by 0.4% from the previous month, the biggest monthly drop in 4 years. Annual inflation also slowed to 3.5%, down from 4.2% just a month earlier. So, what caused this sudden drop? The biggest reason was energy prices. Gasoline prices fell by nearly 10% in just 1 month, while the overall energy index recorded its largest decline in more than 5 years. The question is, has America finally won the fight against inflation? Or is this just a temporary pause before prices start rising again? The latest inflation report was definitely good news. But here's the reality. Inflation is still America's biggest economic problem. Even after June's improvement, the annual inflation rate is 3.5%. That may sound much better than last year's highs, but it's still well above the Federal Reserve's target of 2%. In other words, prices are still rising faster than the Fed believes is healthy for the economy. Core inflation, which excludes food and energy prices, came in at 2.6%. While that's lower than before, it still remains above the Federal Reserve's 2% target. Another challenge is that inflation has been rising faster than real wage growth, meaning millions of Americans are still losing purchasing power even as inflation begins to cool. Even if workers receive a pay raise, it often isn't enough to keep up with the higher cost of everyday life. Groceries, rent, healthcare, insurance, and other essential expenses continue to take a bigger share of household budgets. This is the piece that explains why most Americans think the economy is in worse shape than the headlines suggest. So even in a month where the CPI report looks good on paper, the average paycheck still buys a little less than it did a year ago. Housing is another reason inflation remains one of the biggest challenges facing Americans. Even though overall inflation has eased, shelter costs were still 3.3% higher than a year ago. Housing has been one of the most persistent sources of inflation, and it is not hard to see why. Tariffs have raised the cost of building materials. New home construction has slowed. Fewer new homes mean tight supply, which keeps rents and purchase prices elevated across the board. And the United States isn't just dealing with higher inflation than its own target. Compared with the world's other major economies, America is also facing one of the highest inflation rates. Among the G7 countries, the US currently has the highest inflation rate. While several other G7 economies have already moved much closer to their central bank's inflation targets, the United States is still struggling to bring price growth under control. Earlier this year, the OECD went further, projecting that the US could end 2026 with the highest inflation rate in the entire G7. But just as inflation seemed to be moving in the right direction, the tension between the US and Iran came back once again. As tensions escalated, both countries exchanged military strikes, increasing fears that oil supplies from the Middle East could once again be disrupted. What is worrying the most is the Strait of Hormuz, a narrow waterway through which nearly 1/5 of the world's oil supply passes every day. Whenever there is a risk to this critical shipping route, global oil markets react almost immediately. Traders expect supply disruptions, and oil prices begin to rise. That's exactly what happened. Global crude oil prices climbed sharply in the days following the renewed conflict, and analysts warned that prices could move even higher if the fighting continues or spreads across the region. Higher oil prices don't just make gasoline more expensive. They increase transportation costs, raise manufacturing expenses, and push up the price of everything from groceries to airline tickets. Gas prices at the pump have already started climbing again. The national average moved from around $3.79 to $3.86 a gallon in just a week, and that was before the latest round of strikes. Because CPI data lags reality by several weeks, none of this shows up in the numbers yet. The July report, due out in mid-August, is the one that will actually capture this rebound. Economists are split on how bad it gets. Some think this flares up and cools off again the way past rounds of the conflict have. Others point out that strategic reserves in the US and China, the buffer that's kept a lid on prices through most of this war, are running thinner than they were back in March, which leaves less room to absorb the next shock. This is where the Federal Reserve comes in, and why 1 month of good data doesn't change much for them. In May, Kevin Warsh became the new chair of the Federal Reserve at a time when inflation was already under pressure from rising energy prices. At the Fed's June meeting, policymakers kept the benchmark interest rate unchanged at 3.5% to 3.75%, choosing not to raise or lower borrowing costs. Most Fed officials believe the next move is more likely to be another rate hike than a rate cut, if inflation starts rising again. That puts the Federal Reserve in a difficult position. If it raises interest rates, borrowing becomes more expensive for households and businesses. That can slow spending, reduce investment, and eventually weaken economic growth. But it also helps bring inflation under control. On the other hand, if the Fed keeps rates unchanged while inflation picks up again, it risks falling behind the problem and allowing higher prices to become more deeply rooted in the economy. Inflation is also becoming an important political issue. After years of higher prices, many Americans are still unhappy with the economy. That frustration is turning inflation into one of the biggest issues going into the midterms. President Trump keeps blaming the last administration for today's inflation problems. However, when Trump took office, inflation was sitting around 3%. Now, as of June 2026, it's climbed to 3.5%. Inflation got closer to the Fed's target for a little while earlier this year, but then tensions flared up again in the Middle East, oil prices jumped, and that put fresh pressure back on prices. Inflation was never just about one president or one policy. It's shaped by a mix of things: government spending, interest rates, global supply chains, energy prices, conflicts overseas. People don't judge inflation by reading economic reports. They judge it when they fill up their gas tank, buy groceries, pay rent, or pay their monthly bills. And as long as the cost of living remains high, inflation will remain one of the biggest political issues facing both parties in the months ahead. So, is inflation finally cooling down? The answer is yes, but only partly. June's inflation report was encouraging. It showed that price growth slowed more than expected, giving consumers, businesses, and the Federal Reserve some much-needed relief. But the fight against inflation is far from over. Inflation is still well above the Fed's 2% target. Core inflation remains elevated, real wage growth is still struggling to keep up with rising prices, and the United States continues to have one of the highest inflation rates among the G7 economies. Now, renewed tensions in the Middle East and rising oil prices have created another major risk. If energy costs continue to climb, inflation could begin rising again in the months ahead.